I thought what I'd do today is offer you my sense of how the economy's doing and what a year 2020 has been on certainly the healthcare front, the economic front. Many issues have challenged the public institutions as they carry out their work. So I'll offer you a perspective on how I see things unfolding, how the Federal Reserve has positioned its monetary policy, and then I'll close just with some high-level observations about the banking system and its functioning today and some of the challenges that I think it's going to face in the years to come. I think in Sonia's introduction, her comments about the backdrop for how I think about national policy really does come from the region that I serve. Those 7 states, our connections in those 7 states are so critical. So when you think about the diversity in that region, obviously wide open spaces, many rural places in that region, but also a number of metropolitan areas. And so you see a range of economic drivers from agriculture to aerospace in that region. We have auto manufacturing, energy is dominant in this region, transportation to the ski slopes of Colorado and the tourism that comes with that. And so making those connections in our region really are essential to me in terms of how I understand the economy is unfolding and what the drivers are of that. So you will see us collecting regional data through surveys that range from hearing from our manufacturers, those that are in ag finance and other parts of the economy, to actual engagements one-on-one. So making sure that we're connecting in with consumer groups, with business leaders, with those in the community that serve a variety of needs. And hearing from them really tells us not only how people are experiencing the economy today, but you can hear in their stories, in their assessments of the economy, how they are looking ahead. Where will they spend? Where will they hire? And I think particularly important today is how confident are they about their economy, their local area as we go forward. So all of that will influence what you'll hear from me this morning about how I see the national economy. We, of course, as you know, really fell off a cliff in the second quarter when the economy essentially shut down because of a public health issue. And so coming into the third quarter, the recovery that we've seen has really been not only more robust, but frankly more rapid than I thought it would be. I think it was more robust than even financial markets and many of our business contacts thought it might be. When you look at retail sales, they bounced back really to pre-pandemic levels. The labor market has also made up a lot of ground. So some half of the 22 million people that lost jobs in March and April have seen a comeback to many of those jobs. And there are a couple of reasons I think that we saw a particularly strong bounce back. One, of course, is the fact that there's been an evolution in the way that public health authorities are responding to the virus. And by that, I mean, initially, you saw these broad-based lockdowns, and that has shifted to more targeted restrictions. So certainly everything in the economy is not opened up again fully, but you are seeing increased willingness and ability of the public to engage in certain activities. The second thing, though, that I think we can't lose sight of is really the massive and very quick government support that came out, and that's played an essential role in this recovery. One measure that I think is really noteworthy is considering how many jobs were lost. It wasn't surprising that we saw wages and salaries fall to a record low in that second quarter. But when you look at personal income, which includes those transfer payments that came from the government, they grew at the fastest pace in history and reached a new record high. So clearly, the recovery that we've seen has importantly come from not only better public health measures that allowed people to get out, but also the response from Congress. The Federal Reserve itself has played an important role in buffering the effects of the pandemic with its own set of quick and I would argue very aggressive response. So going back to early March when the Federal Reserve cut its benchmark interest rate to near zero, also began buying significant quantities of Treasury securities and agency mortgage-backed securities at about the pace of 120 billion a month still. And a number of new credit facilities were established to promote the flow of credit to the economy. And again, unprecedented in terms of the scope. So some of the tools that had been used during the last crisis were pulled off the shelf. The new ones were introduced, things like municipal finance credit facilities and a corporate bond facility, even one that we call Main Street. So the good news is that the recovery so far has been more pronounced than many expected. But I think you would agree with me, if you were to pull back the covers of some of those aggregate numbers, you would see that unfortunately the gains have not been evenly shared across the economy. And that, of course, is because of the unequal toll that the pandemic has taken across different sectors of the economy. Things like restaurants and other services that people would normally consume outside the home have been able to only partially recover during the third quarter. And some, if you think about movie theaters or concert venues, those still are virtually shut down. On the other hand, we see some sectors which I heard some people described as booming, and I think that's probably true. Things that we consume in terms of goods have more than recovered. So there is a home improvement frenzy going on, if you will. People have been buying more electronics, including personal computers, probably in part to help kids learn at home, to help people work from home. Even things like bicycles have shown really considerable strength during this period. And I think there's no question, if you look at low interest rates, those have undoubtedly boosted the purchase of some of those goods, and I think certainly have underpinned the strength that we see in the housing market. So the unevenness in that recovery, of course, also shows up when you look at the labor market and try to make some judgments about how that job market is doing. We peaked at around 15% unemployment in April. That, of course, has come back now to just under 7% by October. And so I think all signs are we are moving in the right direction, even if we still have a ways to go. And by that, I mean still some 10 million people are unemployed and others are dropping out of the workforce right now. That sharp drop-off that we saw in jobs still remains concentrated in service-providing industries, which I think if you looked at past recessions, you would have seen that usually is a pretty stable part of the economy. And it's usually manufacturing and the goods sector that really take a hit. So it's different this time in terms of the sectors it's affecting. If you're in retail, if you're in leisure and hospitality industries, you've been hit pretty hard. And those have also noted some of the largest gains more recently. The other aspect of unevenness that I see in that labor market that I think we will have to watch in terms of how robustly it comes back is these job losses have hit particularly hard on women and people of color. So women and minorities are represented disproportionately in those service providing industries, and they, of course, are bearing the brunt of some of those job losses right now. So the pace of recovery encouraging, that is true, and my outlook is the economy will continue to recover. But when you think about what lies ahead, there are really two risks to my outlook, and they probably won't surprise you. One of those is the virus itself. In fact, my colleagues and I that sit on the Federal Open Market Committee have noted in our statements, we talk about it at our meetings, and that is the path of our economy and this recovery is going to depend significantly on the course of the virus. And so today, when we see a resurgence across nearly every state in the virus, we are beginning to hear about renewed imposition of control measures and restrictions. Those are the kinds of things that give me some pause to see how will that affect the recovery going forward. It could throw it off track in some sense. We've already seen this dynamic playing out in Europe, where cases have spiked again in many countries after falling over the summer. So I think the truth is the economy is going to struggle to really fully recover until the virus no longer interferes with the public's day-to-day decision-making or their ability to resume fully the activities that they had coming into this. And that, of course, I think is going to depend on some level of confidence that the virus can be managed. Hopeful signs that a vaccine may be coming. There may be other things that will allow the public to begin to resume those activities. The second risk, in addition to the virus, though, is to say what I said earlier, and that is part of the strength of this recovery has come from the supports from fiscal policy. So Congress is able to make decisions that can target money to sectors of the economy that would benefit most. That's really different than what the Federal Reserve does. When we begin to lower interest rates, that has broad-based effects. But I think when we look at the sectors of the economy that have been sustained during this period, whether that's individuals or small businesses, that has been important. And so today, as we see some of that funding begin to fade, and there are questions about whether there will be additional monies, that is a risk just to watch and say, what will that mean as that funding dissipates, and will there be additional funding, again, to bridge the recovery? Right now, it looks like those that are most at risk are the groups I talked about. They are those workers that are in segments of the economy that are not able to come back until the virus subsides in some way. They are small businesses, which of course are very important in my region. And I think also important here are state and local governments. They have had to boost spending on public health measures at a time when they're experiencing significantly lower tax collection. So when you think about deteriorating budget positions for state and local governments, it seems likely that they too may need some support in going forward. So the recovery has been encouragingly fast, and my outlook is that the economy will continue to grow. But I think it's fair to say there are important risks to that outlook. And I guess my bottom line would be we are not out of the woods yet as it relates to the economy. Let me turn then to how my colleagues and I have been talking about monetary policy and its settings. As you know, we met last week, and at that meeting, the FOMC decided that it would keep its current policy settings unchanged. And so by that, really, I think about it in three parts. One is the short-term interest rate remaining near zero, continued growing of the Federal Reserve's balance sheet by about $120 billion a month. We're already about at that $7 trillion mark with our balance sheet. And the third thing is maintaining these credit facilities that have been provided to a wide range of borrowers, including small businesses. That direction, that guidance to really continue to monitor the economy, keep that policy at very accommodative levels, I think is important as we watch the recovery progress and really try to get signs of when it becomes more self-sustaining and continue to reach its potential. So you are unlikely to see the Federal Reserve talking about normalizing or beginning to pull back on its accommodative policy until a couple of things. One is, as we are tasked with by Congress, watching carefully what's happening with employment and with price stability or inflation. And as we watch those two things, those will really be the drivers, I think, for how the Federal Reserve thinks about any changes to its policy. There's always a question about how long. How long will rates stay low? How long will we stay at this highly accommodative level? And I think one of the things you have to look at is the outlook for inflation, for example. It's not clear yet, given all the disruptions we've seen in supply chains, while at the same time seeing other sectors that are depressed, where inflation is really going to settle out in terms of its path forward. So we know, for example, that there are a few sectors that have been hard hit, and the collapse in demand for them is going to put downward pressure on inflation. In other sectors, though, so think about these home improvement projects, and if you've tried to get a contractor or have some construction work done, you know their strong demand may actually be boosting prices. So looking across the basket of things that are measured for inflation, I think it could take us a while really to judge, will inflation take off, or if the pandemic unleashes some deeper or more prolonged recession, of course, you could see the drag on inflation be more pronounced. So something that I think will be an important guide to how the Federal Reserve thinks about its interest rate policy going ahead. Let me close with a few thoughts on the banking system. Again, so important to how this economy has been able to function going through the pandemic. And I will focus my comments by and large on smaller institutions, particularly community banks, which are not only very prevalent in the region I serve, but I think often we forget how important they are to the macroeconomy and to the nation in terms of how they provide credit to small businesses, how they foster the vitality of many small communities around the country. And so what we've observed the past 8 months is really how critical these institutions are to deploying, whether it's the SBA's PPP program that came out fairly early, to their own actions with their portfolio of borrowers very quickly before any government programs came out. We're sitting down with people to understand how can we assist you. The deferral of payments and other things have been critical to, I think, the success that we've had so far in terms of an economy that's been able to recover. And that role, I think, will be one that will continue. I hear from bankers questions about what will credit look like as we go forward? How much longer can some of these borrowers hang on? All fair questions, I think, as we look ahead. And also, let me touch a little bit about the payment system, because again, community banks find themselves needing to deploy the same technologies that we see increasingly being deployed on platforms outside the banking system, as well as by some of the largest organizations. So let me hit on some of these issues as it relates to that set of banks in terms of what does it mean to have low interest rates for an extended period? What will it mean for the supervisory environment over the next few years? And what about their role in the payment system? Monetary policy, as I just said, is probably not only situated in a highly accommodated place, but if you look at the forecast from my colleagues around the FOMC table, you will see that it is anticipated rates will remain low for some time. And that, of course, has particular implications for banks whose business model is what I call a traditional lender with a core deposit base. Obviously, those low rates are benefiting right now your borrowers in terms of mortgage refi activity, auto purchases, any number of things. So it may have positive effects in terms of boosting loan demand. But of course, we hear very clearly, and I see it in the data, it also brings particular pressures to community banks on net interest margins. An extended period of low rates not only gives you issues around compression of those margins, but obviously challenges profitability and the ability to manage future credit losses. So the cost of that can be particularly felt on our banking sector right now. And that's why making sure that the accommodative policy reaches its aims is important. What you don't want to see is unnecessarily incenting institutions to reach for yield or taking on more risk to try to overcome that environment. In the area of bank credit losses and the supervisory framework, obviously the three banking agencies were very quick to work with the banking industry around relief on some traditional measures of capital and liquidity to allow banks to be able to engage with their customers. And I think that was the right decision. The question is, how much longer will that sort of forbearance remain in place? And so I watch that carefully, as I know you do too, because bankers are already beginning to look at their own portfolios to see which of these businesses are likely to survive this period, in what ways will they be altered, and where might you see future weaknesses in that portfolio. So that will be an area I think important, not only to work with banks from the regulatory side, but I think importantly, hearing from the bankers themselves who will understand most keenly where those risks lie in their own portfolios and how you see those losses unfolding in the months and years ahead. And then finally, let me just say a word or two about the landscape, which I think has been unfolding for some time around how consumers pay for things. Obviously, the public has gotten quite used to being able to transact purchases online and increasingly wanting to pay for things online as well. And that happens in a variety of ways today. But the ability for individuals to trade money, for businesses to transact, is still running on rails that involve a check system, an ACH system, that actually don't deliver those payments as instantly as people may think or want them to. So several years ago, the Federal Reserve began to seriously engage with the banking industry and others to say, how does the U.S. payment system need to be modernized? And I know all of you see many of these changes unfolding, and you've been loud and clear with the Federal Reserve about how important it is the Federal Reserve provide the kind of infrastructure that will allow the payment system to be broadly accessible, from the largest to smallest banks, to be able to have integrity or safety with that system, and to be transparent in how it is priced and delivered. And so last year, the Federal Reserve made a decision to build a new service, which has been called FedNow. And we are well underway in terms of constructing a real-time settlement for retail payments that individuals will be able to use through their banks, that businesses will be able to transact with. And I think combined with the current system that the largest banks have built should fill out for this country a very modern rail on which to transact payments and reflect, I think, the opportunity for more innovation to build off of that. So that's an important initiative that's underway. We are a couple of years from delivering that, but already beginning to work with the banking system on how they're getting ready. We've engaged with a pilot program, because we know it will take some time to reorient systems, to get standards and all the rules in place that will allow the public to be able to use this new system. So an exciting time on the technology front, even if it is also challenging at the same time. So let me close before I take your questions again. And just note, the economy is on track in terms of a recovery, but of course, how it unfolds over the next year is going to depend on how this public health issue gets addressed. It will depend on what kind of supports are available from fiscal authorities, monetary authorities, in terms of how robustly that recovery can continue. And of course, the Federal Reserve has noted its commitment to do what it can with the instruments of policy at its disposal to support that. And let me also say that the Federal Reserve, and particularly the Kansas City Fed, remains keenly focused on the role that our smallest institutions play in this country, and the support of small businesses, the support of our communities. And we look forward to working with you, whether on the payments front, a supervisory front, as you meet those needs of your community. So with that, thank you again very much for the opportunity to speak at this year's conference, and I look forward to your questions.
Thank you, Esther. Appreciate it. We have a few questions that have been posed, so we will look at those here. I'm sorry, I'm reading and familiarizing myself with them. The first question has to do with digital currency. And the question is, what is the Fed and the banking system or the banking industry planning to curb the use of digital currencies used to facilitate criminal activity? And a secondary part to the question is, why are digital currencies exempt from BSA and AML regulations?
So there's a lot in that question. Let me just start by saying, first of all, that the rules around BSA and AML obviously get functioned through the banking system, and to the extent that things are running through the banks, I don't have to tell the bankers in the audience that, you know, the regulatory agencies do hold you to high standards around how payments are made and funds are moved through that. That law, however, does extend very broadly to that. And the question is, who enforces that? So ultimately, law enforcement, even beyond the banking agencies, are responsible for that. The question about digital currency, I think, is an interesting one, because we are beginning to see a very quick evolution around everything that I think started out with a product called Bitcoin and various iterations of that, to now today hearing from central banks saying that they are studying this issue. In some countries around the world, actually creating prototypes for thinking about future deployment of a digital currency. And I think if you break it down to why would central banks be doing that, the question is, we are beginning to see more and more adoption of what I call private money versus currencies that have been used under government authorities to make sure that they are stable and reliable to the public. And so I think you're going to see a tension between the evolution of private money and governments thinking about what role they play. And for that reason, you will see even the Federal Reserve has launched an effort called Project Hamilton that is being led out of our Boston colleagues working with MIT, just to understand what are the dynamics of something like this. I'll close on that point, though, by saying one thing that will make this different country by country is when you think about the United States, we're a country whose currency is still in high demand. So people around the world want to hold dollars. It is still the trading currency around the world where many goods and trade settles. And so it doesn't seem likely that anytime soon you will see the Federal Reserve making a switch to that. In the meantime, I think it's appropriate to keep studying that and to watch what other countries are doing.
Our next question is, with the unprecedented amount of liquidity in the market, how should depository institution liquidity strategies be modified for the future, considering that at some point there will be a normalization?
It's a big challenge, I think, for our banking industry right now because a lot of money is there. We see a very high personal savings rate right now for households. And as you can imagine, in a zero interest rate environment and with some concern about what might be coming next, you will find people, I think, hanging on to their money as a way to buffer themselves against any future shock. We saw this after the great financial crisis, some tentativeness in terms of deploying money, and I suspect we'll see that again, people wanting to protect themselves, maybe even businesses wanting to hold more cash. The challenge, of course, for the banking system is to know which of those deposits might fly away at the point rates rise, which of those are likely to stay. And that will be a function of what opportunities exist in the economy and a function of confidence. So a particular challenge right now, and as I said earlier, being able to manage a compressed interest margin is going to continue to be a challenge for our banks. So I think it's something regulators obviously have their eye on. I think in terms of thinking about stability of the financial system, it's an important issue at the point we begin to see that money flow out, is where is it going and what will its implications be. Susan, you're muted. I can't hear your question, but.
Sorry about that.
That's all right.
So the next question has to do with inflation and what should the target be? Is 2% target too low?
Well, I don't think 2% target is too low because if you think about what it will do to the value of your money over the course of a number of years, the job of the Federal Reserve is to make sure that we have stable prices in the economy. And some time ago, the FOMC determined that price stability should be defined as 2% over the long run. And if you think about for some time, inflation has actually been pretty tame. Some people attribute that to the fact that central banks have targeted numbers like 2%, and that's caused the public to now expect that central banks will keep inflation low. And there are many other factors, structure of our economy and other things that affect the price of things. But I think what's important is 2% is a long run way of thinking about keeping prices stable so that businesses can make decisions for the long run, so that households don't have to worry about the value of their money. The question, though, implies, is it too low? And my answer to that would be no, I don't think so. I'm not sure that trying to pick the exact number, that's always a function, I think, of how the economy's doing. But the question probably comes because we've seen that inflation has run under that 2% target for quite some time. And that has caused the Federal Reserve over the past year to really look at how we talk about that 2% inflation target. So in September, the FOMC released a new framework, really a communication to the public that says, here's how we think about it. We are going to stick with that 2% target over the long run. But what we mean by that is it's not a ceiling. If the economy is growing in a way and jobs are being added, and we begin to see inflation get up to 2.2, 2.3%, that isn't going to cause us to put the brakes on and begin to raise rates. So that on average, 2% in the long run is what we're looking for. So that isn't a mathematical calculation, but I think to the question, it is to say 2% isn't a ceiling, but you can expect that the Federal Reserve will really be gauging how is the economy doing in the context before it makes decisions about changing interest rates.
Thank you. Let me pull up our next question. So the next question that was posed is, Dr. Michael Osterholm is advising Joe Biden to lock down for 4 to 6 weeks. What are the Federal Reserve's thoughts on another economic shutdown, and how much influence does the Federal Reserve have on this decision?
So it's, as you know, one of the risks that I noted as we see the virus resurging. And I think what's important here is public health authorities are front and center on this issue. I think it's important that medical professionals and others are telling us what has to happen to protect the public so that the economy can move forward. We saw the tremendous cost in March and April of these broad-based lockdowns. We also saw that as the medical profession began to say, here are other things that can be done short of these lockdowns, ways to manage the virus. So I will be watching that very carefully. I think, again, I'm not an epidemiologist, and we have to rely on those that can tell us what will contain the virus and allow us to function. But my hope is, both with the prospects of the vaccine, looking at other ways that we've been able to manage the virus, if we can do those things, it certainly will be better for the economy. It will be better for the people that work in that economy and are able to continue to support their families and support, I think, many of the activities that people really rely on. So I hope it doesn't come to that.
Me too. The next question that we have is around negative interest rates. So the person says, what are your thoughts on negative interest rates? Can you foresee that happening in the future if the pandemic continues to resurge and the economy takes a turn for the worse?
So negative interest rates have been deployed. We've had a chance to see other parts of the world use negative interest rates, and my own sense is that has not been an effective tool of monetary policy. And in fact, the Federal Reserve has said, as it's looked at a range of ways that it could respond to the economy, has said, we're taking negative interest rates off the table. We don't see their applicability in the US. We're not in a place where we've exhausted other things. And so I hope we don't come to a point where that's entertained again. And I think right now we don't have to worry about that. That means, though, that the Federal Reserve will be looking to things like how long it keeps rates low. It will be looking to things like its balance sheet. And so all of those, I think, should tell the public the Federal Reserve will keep doing what it can to do its part for the economy, but they're worth watching because every one of these tools carries some cost at some point. And so watching how they are deployed, what their cost and benefits are, will continue to be in focus for the Federal Reserve.
Okay, great. So the last question that we have so far is, you mentioned a more targeted approach to restrictions in response to the pandemic. How likely is another total shutdown? I think this is a similar question. And what impacts do you see on the economic recovery? So I think you may have already answered a lot of that, but.
Yeah, I think, again, obviously, a total shutdown is catastrophic to our economy. And I don't think anybody wants that, particularly because it has not proven, I think, in some cases, to not cause a resurgence. It also is problematic, I think, though, as we listen to what things can be done. We have seen variation across the country and how well people adopt some of those practices, too. So large gatherings, the advice we're getting about distancing and mask and all those, I think will really determine how well the economy can reopen. And ultimately, we want people to have confidence. People will make their own choices about whether they're going to go out and engage with the economy as they did before. And having some confidence that they have ways to protect themselves or have ways that they can do that safely, I think is going to be important. So that conversation looks like it will be ongoing, particularly at a time when we see the case counts rising.
Great. Okay, I think we have a couple more now that have come in. This one says, I recently saw that over 70% of stimulus money was used to pay down debt or saved. This should put consumers in a very good position to be able to spend money in the future months. And there is a lot of pent-up demand for travel, entertainment, and housing. Do we need anything more than a small stimulus package targeted toward businesses that are affected most by COVID?
Yeah, it's a great question right now. So I'm going to answer that in terms of what else is needed and what might consumers do with the savings in terms of pent-up demand. Let me start with how much additional is needed. I think, obviously, this is a question that Congress has to answer. And the reason I say that is not just because it's not the Federal Reserve's job. We have a very specific job around making sure financing conditions are very easy. But Congress is able to really target funding in a way that the Federal Reserve is not allowed to and shouldn't, in my view. And so deciding how much and where is really a job that we've handed to our representatives. And so they, I think, will have to be thinking about what role they play as we go forward. The question about how people are saving right now is one that I've had my own team looking at to say, should I expect with people's savings levels being high, that will just be waiting to go out and boost demand? In other words, will we need any other kinds of supports? Will that provide its own demand? And certainly there will be some of that. I think what you have to be keep an eye on, though, are a couple things. One is what I call the fear factor. We know that people will hang on to some of that money for a while because they may be concerned. Could I lose my job? Am I going to be at risk here in a way that I should create some kind of a safety buffer for myself? So that will be a dynamic we will have to watch, how much of those savings people will hold on to and for how long. The second thing is where the pent-up demand will come from. So as I noted earlier, where we see a lot of activity is actually in consumption of goods. So people are going out and buying things while they are at home or limited in travel or other things. The question is, when they're able to resume services, how many more trips will they take? If you missed one trip, will you take 3 next year to make up for that? You've heard the story of, if I haven't gotten a haircut in a while, I'm not likely to get more of those in any one setting. So I think there is a real question of how many of those services will make up for what's been lost or will extend the time in which they buy it. So no question, as I said, the job loss, the wage drop we've seen has benefited enormously by giving people that safety net, that cushion. If you're someone whose income is largely consumed by your rent and your food, you're probably not going to have as much of a buffer, or you'll be more concerned about that. Those at the higher end of the wage scale or income probably don't have the propensity to consume all of that anyway. And so That is an area I think we'll watch carefully. So watching what other supports come from fiscal authorities as they judge the economy, and then watching how households ultimately deploy what right now looks like a high level of savings. How much of that can they put out in the economy in the months ahead?
A couple more questions have come in. What are your thoughts about loss exposure on commercial real estate loans over the next 24 to 36 months?
Yeah. So my thought is this is always an asset class that gets hit first in any kind of stress situation. And we know many of our banks have a portfolio that includes that asset class. So obviously there have been regulatory actions in the past to try to gate that, to hold more capital against it and other things. But I think it could be the first asset class that we began to see some of the weaknesses. Obviously, we've seen low delinquency rates to this point, but I think as our bankers note, that's been because of some of these efforts to forbear, to defer payments and other things. So I think it's right to watch that. And that's why I say, obviously regulators will be watching, but I think the bankers are the ones I'll be relying on most to say, you tell me which of those customers, because as you know, commercial real estate is a broad category, particularly when you get into a community bank portfolio, and understanding what is behind that and how that property might fare. Obviously, retail properties are going to be under pressure nationally. We see that already. We hear businesses talking about needing a smaller footprint because they think more of their employees will work from home. So that market, I think, is going to go through a period of adjustment over the next few years. And it will be an asset class, I think, that we'll have to keep an eye on in terms of what loss exposures will come out of that.
Great. Believe we have one more question here that's come in. With the national deficit being so great, additional debt will have to be issued. Will the Fed continue to grow their balance sheet by purchasing this debt at the same rate they have in the past, at a greater rate, or will the Fed slow down in their purchasing?
So it's a very important question, and I think it's one that's been on people's minds for a long time. Let me set the Fed aside. I often get questions from the public about the level of federal debt and should we be concerned about that. And so before we ever heard about coronavirus, I think the questions about how much debt can a country like the US carry before we run into problems of crowding out private sector investment, getting higher interest rates, is very much an open question. And the reason I say that is we can look around the world and see countries that get over indebted, and we see that they don't fare very well. The difference for the US is we are the world's largest economy. Again, we represent the world's reserve currency, and it gives us the kind of capacity to carry a debt load. And it's why I tell people during a time like this, during an emergency where the public's lives really depend on it, this is not the time to try to correct for what have been years and years of that debt growing, the demands coming from a retiring and aging population, our healthcare costs associated with that. But there will be a day where that will be appropriate to do. And we always have to be thinking about the long run and what our actions today mean for that. In terms of what it means for what the Federal Reserve is doing, again, I think it's important to remember right now, these really are massive amounts. It is mind-boggling, I think, for many of us to look and see the Fed's balance sheet in this short of a period of time going from under 4 trillion to now 7 trillion and growing. And the aim of those purchases, of course, is to make sure that our financial markets are stable. They're doing that now, but these purchases are keeping low rates at the longer end of the yield curve. This is what's helping the mortgage market right now. So there will come a time when the Federal Reserve will have to address the question of how is the economy doing relative to what we've been asked to do? And what role are we playing in terms of a growing footprint in the financial market with these purchases? I look forward to when that day comes because it's likely to mean the economy is doing better and we can begin to have that conversation. But it's a great question and one that I think we have to keep talking about as we judge both the economy's progress and how fiscal authorities are making spending decisions.
Thank you so much, Esther. I think that was the last question that the audience has posed for you. We really appreciate you sharing such great information for us today and being so open about answering everyone's questions as they were posed. Thank you very much for being with us.
Thank you for having me. And Sonia and Mark, I hope I get a chance to see you all in the not too distant future. So thank you for moderating, Susan.
Thank you.
All right. Bye-bye.